Happy Thursday out there, Team 42. It's your skipper here, Darius Dale, to present our macro minute for Thursday, March 14th, 2024. As always, we'll start with the executive summary from today's leadoff morning note. If you would like to review the analysis supporting these conclusions, as well as what to specifically do about them in your portfolio, you need to be a client of 42 Macro. So today's key macro event is inflation beats and growth disappoints. So the nuance there is that 2-year and 10-year nominal treasury yields are up 17 basis points and 14 basis points week to date, respectively, foreshadowing a hawkish PPI report, which saw producer price inflation surprise to the upside on both the headline and core basis. Meanwhile, retail sales came in light relative to consensus, and despite a strong bounce in auto sales last month. Market implications. So core PPI appears to be bottoming at a level that is inconsistent with the Fed's stated 2% price stability mandate. The Fed has been adamant that their 2% inflation target has not changed, but implicit in every risk asset valuation is the assumption that the Fed will not sacrifice the economic expansion to get inflation from 3% to 2%. That is structurally bullish for stocks, credit, crypto, and commodities, and structurally bearish for the US dollar and treasuries. Elsewhere, investors would be remiss to ever overreact to a retail sales print, considering that the goods sector only represents 35% of personal consumption expenditures and 25% of GDP. The services sector is far more dominant at 65% of PCE and 45% of GDP. Recall that this compositional dynamic was core to our development of the resilient U.S. economy theme back in the summer of 2022. Transitioning to our 42 macro dashboard here, always we'll start with the review of the trading range signals from our friends over at Longbow. We do not have any key macro market indicators overbought or oversold. So we'll wrap it up as always with a question from our community. The question reads, "Hi Skipper, by long energy, do you mean the oil, the commodity, or energy stocks? In other words, what discretionary change in the 60-30-10 KISS portfolio construction would one make to reflect that thesis?" So let me start by reintroducing you guys to what our KISS portfolio construction process is. It's a 60-30-10 trend following approach that allocates 60% to stocks, 30% to fixed income, and 10% to alternatives. Our stock choice for alternatives is Bitcoin. I'm a huge believer in that asset class, and it continues to make us a lot of money. But in terms of the KISS, so our default exposure for KISS is SPY for the equity portion, AG for the fixed income portion, and then FBTC for the Bitcoin portion. But we coach investors and we give them the tools and the analysis required on a daily basis, 6 times a week, in order to implement a customized version of KISS. So, for example, if you're an investor that would prefer to be long, the Qs instead of SPY, or you want to diversify that, which a lot of investment advisors do, the investment advisor clients of ours do, they want to diversify that equity exposure into different sectors, into different equity factors, or into different international equity exposures. And so we coach them and give them the tools and the data on 6 days a week to help them maintain what the real value of KISS is, what are the top-down and bottom-up risk management overlays, which are driven by our market regime nowcasting process and our volatility adjusted momentum signal, respectively. So in terms of creating a customized version of KISS that features energy stocks or crude oil commodities, you could either diversify that 60% equity exposure into ETFs like XLE, XOP, which is energy upstream oil and gas producers, and then MLPs, which are the pipelines. Or if you wanted to diversify that 10% into a customized version of your own customized version of KISS, you could diversify that into things like the USO, BNO, UNG is natural gas, and I think there's a UGA is gasoline as well. So it depends on which type of exposure you want, stocks versus commodities, if you're going to be diversifying into energy exposure, respectively. But all those different ETFs we maintain our volatility adjusted momentum signal forward, and obviously the global macro risk matrix, which generates the market regime nowcast, helps us stay on the right side of market risk in terms of the top-down risk management overlay. So definitely come check us out if you need help with portfolio construction and asset allocation. That's one of the things I think we do at an extremely high level. This is why we work with some of the top hedge funds and mutual funds all across global Wall Street that have a high degree of respect for what it is that we're doing, is because we really, we have a very systematic, institutionalized research macro risk management process. We're not out here saying, well, I think of this about XYZ catalyst, and therefore I'm going to be bearish, or therefore I'm going to be bullish. That's what most macro people do. Most macro people are really good at macro tourism. Macro tourism has no place in institutional finance. Nobody in institutional finance talks about the commercial real estate crisis and is bearish because of it. In institutional finance, they have parameters, rules, real institutional frameworks that help them, kind of stay on the right side of market risk, irrespective of what's going to happen in the economy and in asset markets. And that's something that I think we do that's very different from what most research firms are doing out there. So definitely come check us out if your experience with the other research providers, particularly the macro gurus, has been less than stellar, and or you're significantly underperforming the market, as many investors are. So come check us out. We'll be here. So this is Darius Dale wrapping up our macro minute for Thursday, March 14th, 2024. Everyone have a wonderful day out there. Best of luck. We'll catch you back here tomorrow. Cheers.